Hello and welcome back to the 7 Steps to Financial Freedom course. This is part 4 of 7, how to invest to beat inflation. One thing I need to say first though, this is not financial advice. If you do require a financial advice, please seek out a financial advisor who will give you financial advice tailored to your specific circumstances. God, I couldn't speak properly then. Anyway, let's crack on. So this is it, part 4 of 7, how to invest to beat inflation. If you've been following my course along with me so far, you may have already completed mindset and making changes to save money, paying off debts using the snowball and avalanche method, and how to create an emergency fund. If you haven't done them, go back and look at them. If you feel like you don't need to, or you've already completed them, let's crack straight onto it. Okay, so here's what you will learn by the end of the video. What is inflation and why invest? What are good investments? How long should you invest / targets? Is investing trading? How to make your money work for you? And what's next? So, what is inflation and why invest? So, inflation is basically how much the price of goods and services increase every year. So the government try to control inflation, keep it at a set target between 2 to 3% per year, and they do that with a little lever by raising and lowering interest rates. In real terms though, this means that if you leave your money in a savings account, which normally gets around 0.25% per year, which is below inflation. So that's how much money you'll receive, but because inflation goes up between 2 to 3% per year, that means in real terms, the spending power of your money will reduce by 2 to 3% per year. So to illustrate this, I will show you an inflation calculator right now. So as you can see here, if you had £7,000 in savings, and you kept it for 25 years and if you expected, we said 2 to 3% inflation, so I've gone for a 2.5% average over 25 years. After 25 years, your £7,000 will be able to only buy £3,775 worth of stuff. So basically you'll have lost just under half of its spending power over 25 years. So as you can see, you do stand to lose a lot of money over the time. So the best thing to do is try to invest to beat inflation. So that was the example just to show you how much. So basically you don't lose money. You have the same amount, but the spending power of your money decreases. So you might wonder, like, for instance, someone commented on one of my videos of a chair that I made a review on over 3 years ago. It was £160 and now it's the same chair is now £180. And he said, why did you get it on sale? And I had to explain to him what inflation was in the comments of the video. Anyway, let's move on. Invest to beat inflation and try to achieve compounded interest. So that just means that if you can try and invest your money into something that returns more than 2 to 3% per year, you'll beat inflation, thereby increasing your money over time. And you should try and get compounded interest. Now that compounding interest is, so a lot of things you can invest in will give you like a dividend, like 4 times a year. And if you reinvest that dividend into it, that also helps to boost the percentage of return you're getting back every year. And then obviously the real reason why we invest is to try and become financially free in the future. So let's carry on. What are good investments? Well, first of all, biggest investment you can ever make is in yourself. And that's by learning new things, looking after your mental health by doing such things as meditation and having a good diet. Try and eat whole foods. Try not to eat too many takeaways. Limit your takeaways to 1 a week or 2 a month, or none if you can do it. And obviously look after yourself by doing exercise. You don't want to just keep on eating loads of food and getting fat and getting diabetes and either dying early or having to rely on drugs for the rest of your life. And because obviously when you're financially free, you don't should be sat there going, oh brilliant, I can't do anything apart from just watch TV and take 10 tablets a day. So first things I'm going to talk about, after you've looked after yourself's all right. You want to try and live to your maximum age, which is probably somewhere in the 80s or more, depending on your age. A lot of people like to invest in precious metals like gold or silver. I will just show you a gold and silver chart so you can have a look of what it looks like. So as you can see here, this is the price of gold all the way back from 2000. Well, it's 1998, but let's say in 2000, price of gold was $280 per ounce. And then in 2010 it peaked. That was after the financial crash. 2008 it peaked all the way up to $1,900, and then since 2012 it's been on a downtrend until we got to 2015. And since 2015 it has been on an uptrend ever since then. And 2019 last year, and then if you look at this little dip here, if we can zoom in, this little dip here happened. We lost 40% of the price of gold, and this was just after the COVID happened. But then it carried on going up, and since then it's gone up by 22%. So that's quite a big bounce from gold. So what happens in gold is during times of financial hardship in the economy, people like to invest in gold. So if you've been investing since 2016, you'd be up 70%. Well, it depends. If you put a lump sum in there, you'd be up 70%. But if you were just dollar cost averaging, you'd be up slightly less, but you'd still be up. So yeah, that's gold. That's a quite a stable investment. It doesn't go up and down much. That's one investment you could go for. Okay, the next part, there's another investment you could use to beat inflation, and that is property. Are you going to buy? Are you going to let? Are you going to get a mortgage, or are you going to pay in full? Are you going to do overpayments to reduce your mortgage term? Things like that. So all the things you've got to consider. Do your own research and find out. But I'll just tell you one thing about property. It's not a very liquid asset, but what people do is buy to let mortgages on interest only mortgages. So then they'll have to pay out the minimum amount, but they will get rent in return. But there's other problems that go along with that. But anyway, I will just quickly show you a chart of the house prices of London, England and Wales and the northeast of England. Here we have a chart of the average house prices from 1998 to 2015. And the red line at the bottom is the northeast of England. The blue line is England and Wales. And the green line is London. As you can see, that's 100,000, that's 200,000, that's 300,000, that's 400,000, that's 500,000. So as you look at the line, you can see that the prices in the northeast, this is 2008, this is the subprime mortgage crisis. When that happened, the whole house prices crashed and so did the rest of the stock markets. But then in 2009, everything started to recover. So England and Wales and London recovered. And as you can see, the northeast never recovered. London, as you can see, between 2010 and 2015, the London prices carried on to go up. We kind of stabilised in England and Wales, and then 2013, 14, 15, we started going up. But as you can see, the northeast of England never recovered. So this might mean that in the future, the northeast could go up. You don't know. But if you're buying to let, it doesn't really matter where you buy. Obviously, it's going to cost you a lot more to buy in London. So if you're looking for a cheap house, you could buy a cheap house in the northeast of England and let it out. Obviously, you get a lot more for letting something out in London, but it all depends on what you can afford and things like that. So that's another thing you need to do research on. Google is your friend. Okay, that is property covered. If you've got any comments about property, let me know and put them in the comments below, and we'll have a little discussion about that. Okay, what else are good investments? Stocks and indexes. So there's an index called the Standard & Poor's Index 500, which is the top 500 companies within America. And the good thing about it is that you're diversified across 500 companies. It would be very difficult to buy 500 individual shares and individually split your money between them. But with this index fund, you could do that. There's life strategy and it's slight to medium risk. So I will show you the price chart now of the Standard & Poor's Index. So as you can see here, the Standard & Poor's Index from America goes all the way back to the 1970s, and to buy into that then would cost you $99, and now it is worth $3,196. So if you just put a lump sum in there of 1,000, you have gone up by 378. Basically, let's just say you'd have 39 extra money. But that's not how it works, because using the if you invest in the Standard & Poor's Index, there's a chance it can go up or down. So in 2008, let's zoom back in again. 2008, the stock prices dropped because of the subprime index, and they dropped by 50%. This is Corona here in March, February, if it'll let me do it. And as you can see there, the stock prices dropped by 35%, but then after the US printed loads of money and bought loads of stocks and stuff, it bounced again by 44%. So you might think, oh, well, have we got another market fall? You don't know. There's loads of different other ones as well. You need to definitely do your own research on this. If you're going to invest in this, so say if you invested in 2010 and you'd be 200% up, which is pretty much doubled your money. You'd have doubled your money, but don't forget you'd be investing every month as much as you can afford, and you'd also be receiving dividends 4 times a year and reinvesting it, so you'll have compounded interest, so you'd have a lot more than twice your money. But that is the chart of the S&P 500 going all the way back. Let me know in the comments if you think it's going to keep going up or up here somewhere by 2024, or do you think we're going to have another drop maybe next year, or continuing this year down here, then maybe go up in the next couple of years? We don't know. Nobody knows. Nobody can predict the markets. That's the thing. But remember, the important thing about this is you get dividends, which you can then reinvest. But yeah, this is a basket of companies, 500 companies. And so rather than investing in one or two, and what one company goes down, you can then be protected by the rest of the companies. But the same thing goes. If one company does really well, you'll get balanced out by the rest of the companies. But as you can see over time, it does go, there is a general uptrend. But as you can see, if you invest in 2003, you wanted to retire then, you wouldn't have made much money if you wanted to start taking money out of it. So that is around a 6-year period where you would have, because of the 2008 crash, you would have lost, well, you wouldn't have, you could have been down, but if you would have just carried on investing for another 10 years, you still would have been up. So as you can see, over the long term, it'll go up, but it's like, this is called an equity. So stocks and shares are called equities, and they can go up and down, but over the long term, they do go up. So this is why it's a good idea to invest while you're young for 10 to 20 years. I'll give you a little talk about indexes such as the S&P 500. We're now going to go on to government bonds. These are considered low risk, so as you're approaching retirement, so stocks and shares you meant to have most, well, I say you meant to, but this is what's traditionally taught in financial education. So whilst you're young, this is kind of like, this is very volatile. It can go up and down. But over the long term, it's always on an uptrend. But government bonds, most of your portfolio should maybe have moved into government bonds. And a government bond it's kind of like, instead of you getting a loan, you're giving a loan to the government. So you're buying a bond from the government, which they use the money, but it's low risk, but it's low reward. And people do say you should have at least 20% of your portfolio in government bonds to help hedge against the volatility of stocks. So you should have stocks 80%, government bonds 20%. So if there is a drop in stocks, you won't feel it as much, because normally when stocks fall, government bonds go higher. I'll show you an example of that now. I will show you Vanguard Funds. So this is Vanguard. It is a very good company with some of the lowest fees, where you can buy multiple baskets of assets, and they offer different sort of things. So they have life strategies. So as I was saying earlier, you could have, when you were young, you could have 100% equity, and as you approach retirement, you could change to that one, change to this one, change to that one, and change to that. And there's the 28. There's the 28 I was talking about. So we can actually put a detailed view on, and you can see since 2015 what sort of average return these different packages do. Each of them have different fees, so they're the fees there. Target retirement, so this is another one where you can say in what year you plan to retire, and they will automatically adjust and try and make easier for you to retire at that age or that year. They have the equities that I was talking about earlier, different types, but I'm going to show you the bonds. So I can see the risk score down this left side here. 5 is high, and as you go down, well, 6 is higher. But as you go down, we'll go to the fixed income. So these are like bonds that I was talking about. So these are the ones you're meant to have when you're closer to retirement. And as you can see, a lot of them have gone, as we've had a little bit of uncertainty and some of the equities have crashed. Normally you get like very low returns from these, but as you can see, now we're in like July 19 to June 20 because of the coronavirus and everything else like that. There you go. Look, the UK ones have gone up 12%. That's not normal for bonds, really. 20% there. So yeah, so bonds is another thing you should consider investing in, and I would definitely recommend Vanguard, because they do a lot of work in the background to balance your portfolio, and they have extremely low fees compared to some other places. Right, let's carry on. So we've talked about government bonds. They're low risk. I don't actually own any at the moment, but it's something I would consider it in the future when I'm close to retirement. At the moment, I'm only halfway through my life, so who knows. So there are ways to buy individual stocks, and recently, within the last 5 years, investment apps have become very, very popular. There's one called eToro, there's Robinhood, and you can buy single stocks with them. You can buy pretty much everything, actually, not just single stocks, but you can buy everything. So I'll quickly show you that. So this is the eToro website. and they also have an app. But as you can see, they offer stocks, individual stocks, ETFs, which are like funds and index funds and stuff. They also do crypto, indices, commodities and currencies. So here we go. It's show you like some featured ones. Maybe these guys pay to be on the top of the list. There's Netflix there. We've got loads of different ones. Tesla, Beyond Meat. That's like the vegan sort of meat thing. There's Bitcoin, Amazon, Square, Nvidia, gold. So if you go down, we see there's the market movers. Look, Tesla. There's technology stocks there. Amazon, Apple, and all the rest of them. Google, Tesla, Facebook. You've got ETFs. Down here look like emerging markets, energy sectors, things like that. Then you got crypto coins like Bitcoin, Ethereum, XRP, Litecoin, and all the different things like that. You've got indices, which are like what I was talking about before. There it is, look, the S&P 500 that I was talking about earlier. So you can also invest in them as well. You've got currencies. You can either buy the currencies. On here you can invest and you can trade as well. There you go. And commodities at the bottom like gold, silver, natural gas, sugar, cotton, things like that. So on here you can invest on here, but they do try and push you to trade, which is like more short time investing. But with trading, they try to make you use leverage, which is dangerous because unless you know what you're doing, you can lose money. But you've got more potential of gain and more potential of loss as well. So you can invest on here as well. So don't be afraid. Just not to use leverage, and you can invest. Also, you can copy people. So if you just want to put money into it and go, oh, look, this guy, he's got 67% return in the last 12 months. Oh, he's at risk factor 5. I'll just copy him. Look at these guys here. Look at that guy's smile there. Oh my God. He's very happy, isn't he? Look at that. Jesus. That is crazy. Anyway, most copied people, trending people, blah, 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 top investors. You could just put money in there and go, okay, I trust this guy. I've looked at his stats, because you can look into the stats and see how much they've made over the years and stuff, blah, blah, blah. And then you can just copy them. So that's another one you could do. Another one, copy portfolios. You can do all this up. Anyway, let's not talk about it. I've told you about it now. There's eToro's, apps like that. Loads of different ways you can invest, but you do need to do your own research. Only invest in what you're comfortable with doing and what you believe in. Okay, I've showed you eToro. Now we'll talk about cryptocurrency. Cryptocurrency is high risk, but potentially high reward or high loss. Try and invest at least 1%. I'd say between 1 and 10% of your money into crypto. Because the future, and from what I've researched over the last 3 years, and all the different people who are investing into it, and the big banks and all the massive companies are all getting into it, and countries are even getting into it and everything as well. I don't want to go too much into detail with crypto, but I will show you the chart for Bitcoin. So I'll talk a little bit about it in there as well. 2 seconds. So this is the Bitcoin chart. As you can see, this is the current price. The difference between Bitcoin, by the way, and normal stocks and shares is the stocks and shares, we can go all the way back to here when it was literally somewhere down here. You'll see it was like literally £1 or $1 for one Bitcoin back in 2012-13. Then it had a spike in 2013 to 1,000. Then it went down for about 5 years before got to 2004, 5 years. They got to 2017 and it had a massive bull run starting about here, which went all the way up to 20,000 for one Bitcoin, which is pretty ridiculous. And then after that, 2 years later, it smashed down, all the way down, losing 82% of its value, all the way down to $3,000. And since 2000, that was during 2018-19. And after that, it spiked back up into July 19 to over 292%, up to 14,000. And then after that, the Corona, this one here where it spiked right down is because of Corona. People got out of it for a reason. It went back down to 3,800. And then after that, people realised, hang on a minute, let's put the money back in. This is good value, if I can do it. And then it smashed all the way back up. And now this month here, in July 20, we're currently at $9,248. Now there are predictions that in the next 2 or 3 years, we could be seeing prices of, because of the halving, and if you don't know what the halving is, you should research it, but basically means the amount miners who mine Bitcoin get every 4 years gets halved, which decreases the supply, in turn should increase the price. Think about the stock, if you want to research it, research the stock to flow model, Plan B, Model Investor, And there you go. So they reckon by this year, where I am now, price could spike up to 100k, but then it could come all the way down like it did there, back down to about 30k. Nobody knows. Nobody knows what's going to happen in the future. But some people, this is considered a risky asset. Some people like to invest in risk. Some people say it's gambling, but over the long term, as you can see, if you would have bought here, if you would have bought 10 Bitcoin there, $15 each, you would have 10 times 9,000. So you'd have nearly $100,000 if you just bought 10 Bitcoin then. And if you kept buying it every year, obviously you'd be just a millionaire. So it's up to you. If you think it's a good investment, definitely do your own research. Research how to store it properly. Not your keys, not your Bitcoin. Type that into Google. Things like that. I think it's a good investment. I do own some. Not very much, but it's a good investment. All part of a balanced portfolio. Remember, diversification in assets is key. Don't have all your eggs in one basket. Okay, so we've gone over all of these different things here. We've got a lot to think about, but remember, because of inflation, pretty much anything you invest in, as long as it goes up over the long term, which most things do, anything's better than cash because cash loses spending power. And the whole idea is to try and maintain your wealth or increase it. Over the long term, as long as you diversify, you should be good. And if you are going to buy individual stocks, I would probably go for the blue chip stocks, things like Coca-Cola, McDonald's, Amazon, Netflix, called the FANG stocks. So things like Facebook, Amazon, Google, all of those ones, good ones like that. Don't forget individual stocks also give dividends, some don't. And if you look on the eToro site or just Google it, you'll find out which ones give you dividends. And always remember to reinvest your dividends and you will have compounded interest, which is the most powerful thing. And I think there was a quote by Albert Einstein who actually said, compounded interest is the wonder of the modern world. So what I've written here is invest in what you believe in and understand and try to dollar cost average. So there's a difference between dollar cost averages and lump sum amounts. If you believe that the market's completely crashed and you've got a pile of cash, maybe you do a lump sum investment, but it's very hard to catch the bottom of the market. So if you dollar cost average, which basically means put as much as you can afford in per month, maybe you won't see much of a return, but as the market goes down, you'll still be investing, and then it goes back up again, you should be up. So you got more chance of like catching a bottom of the market if you invest monthly and things like that. Also think about trying to create an online business, because any extra money like side hustles and things like that you make, you could use that to maybe cover your expenses so you can even invest even more. So the big box here, DYOR, do your own research, research everything, read books, watch videos, do courses like this one until you gain the confidence. Investing is very scary, but some people might think, oh, it's too late to buy these stocks. No, it's not, because in 10 years time, those same stocks will be worth lots more. So there might be times when they go down, and over even a year or more, it might go down, but over the long term, 10 years plus, they will always go up. How long should you invest and your targets? I would definitely advise to invest as much as you can afford to invest. And the scale of time you should invest is probably between 10 to 30 years. So you need to try and aim to reduce your expenses every year. Try to pay off your mortgage, and it doesn't mean like you should do overpayments, or you might not. I mean, it's a good idea to do overpayments because that gives you it's pretty much like investing and getting 2% or whatever your current mortgage rate is at the time. But you could invest instead. You could pay your mortgage as normal and invest in something that's giving you more percentage per year and use a lump sum from that investment to pay off your mortgage. I would definitely advise that part of a FIRE lifestyle is to either reduce your housing costs or pay off your mortgage, or I don't know, let's go the extreme, van life, or join the army where expenses to live are cheap, things like that. But yes, pay off your mortgage. Before you retire, there's nothing worse than trying to retire with a mortgage. So over time, make a spreadsheet. I've got my own spreadsheet to track your expenses, work out, track your investments, keep on updating them. Then after a while, you should be able to work out a picture of the age you should be able to retire. Try and go for like a worst case scenario, or when you're trying to calculate your investment amounts. So instead of saying, oh, I'm going to get 10% a year, just go for worst case, so I'm going to get 5% a year after inflation, something like that. And then you should be able to retire or soft retire by the age of 40 or 50, depending on when you started. Obviously, I'm over 40, so I haven't retired yet, so I'm still working, unfortunately. But if you're younger, if in your 30s or your 20s, you should definitely be able to retire. I mean, if you're 20s, there's no reason why you should be able to retire before 40 if you invest. And if you're in your 30s, there's there's no way you shouldn't be able to fully retire by the age 50, if not earlier. So don't forget your target depends on your age. Just work it out. Use a spreadsheet. I will be doing a video at some point about spreadsheets and how to work it out, how to work out your retirement age. I'll do a separate video on that. Probably not as well, a lot more to the point and, you know, more focused than this one. But this is like an overall investment. So the whole idea is your income and your investments should be able to cover your day-to-day living expenses, and hopefully by this point you haven't got a mortgage, so you're just thinking about food and bills and stuff like that, maybe holidays, whatever, gifts. But there's a thing called the 4% rule, which basically means, I'm going to go more into depth into a later video, but basically means the 4% rule is, say if you're making 10% a year on your investments, you should be able to take out 4% of that money and still have another 6% going up. So your investments are still going up while you're retiring. You don't have to do that. You can take out more. You might not want your investments to go up. You might want to just dwindle them away and not give any money away. You might want to work it out so you've got nothing left by the time you die. But if you do if you do want to have money left to give to your kids or your family, try and take out less than you're making. But if you're selfish, you might say, if you're making 10% a year, you might think, oh, I'll just take 10% of my money out and it'll just stay the same. Or you could take 20% out and slowly dwindle away at your money. But at the end of the day, do spreadsheets, do your own research, get excited about this, because obviously financial freedom is a very, very good way to live, because then you can do what you want for the rest of your life. You don't want to be stuck in an office or stuck behind a cash register or whatever else you're doing, just living your life. I mean, if you're happy doing that, you know, working for the rest of your life, this course is designed for people who want to change where they are with it. Like, they don't want to be the same in 10 years time or 20 years time. So we're going to go more into like how the life, you know, not the meaning of life, but like life goals and finding your life purpose and stuff in later videos. Just carry on. So is investing trading? So trading is attempting to buy an asset at a low price and sell it at a higher price for a profit. Obviously, if you become a trader, there'll be more taxes and charges involved. But investing is trading, but it's a very, very slow version of trading. Because obviously you are buying at a low price, because in the past things didn't cost as much, or these stocks and shares didn't cost as much, and in the future you intend to live off it, or maybe not. You just keep working and pass your investments on to your family or your kids or something like that. But at one point the money will be spent. Or what is the point? Because this is competition with yourself. See how much money you can make, and then just look at it, go, oh, brilliant, I've got all this money. But yeah, you should be idea is to try and live your life, do you know what I mean? So if you do decide to trade, there's like day trading and there's swing trading. Should you do that? Probably not. So basically, the smaller time frame you use, the tighter, if you do decide to do it, the tighter your trading rules should be. You need good discipline, and you have to be zen-like on your emotions. So you need like a rule. You need rules, man. You need, I've tried it before with small amounts in the past, and it's not as easy as you think. You might be thinking it's easy, buy low, sell high. No. Once emotions get involved, it's different. So that's why you need a system. You're supposed to stick to your system, even if you're making lesser amounts. But anyway, I wouldn't recommend trading. It's far too stressful. You'll be looking at prices all the time. You won't have a life. You'll be looking at stocks and shares all the time. You'll be looking at your investments, your trades, and you'll set like alarms to wake up in the middle of the night to do stuff. You don't want to do it, trust me. And also, 85% of retail traders, that's me and you, normal people, not the big massive investing companies, stuff like that, lose money. And that's, as I said before, due to emotions, not following their trading rules, ego, like you know what I mean, greed and lack of discipline. Also, trading with leverage, which means, say if you've got £1,000, you can do 10x leverage, so you've got 10 grand. Basically, leverage, you can trade more than you've got, but you can literally liquidate your whole position, which means all your money is gone. So you don't really want to trade with leverage, because it can cost you everything, and sometimes even your life. Sadly, there was a guy who died who, I can't remember which trading app it was. It might have been Robinhood, actually. It was some trading app where he lost all his money, and as well it let him go into minus money. So he ended up, I think he had millions, but they ended up minus $500,000 or something like that. I think he just hung himself or jumped off a building or something. So it's a very sad story, but just don't trade with leverage. I mean, leverage is, like I say, it's like a tool, but unless you understand what you're doing, you'll probably lose money every time. You'll just, I say, like the 97%. It's very high risk, very high reward. You'll probably be stressed for the rest of your life, unless you're some sort of Zen master, meditation monk, trading monk. Anyway, you can decide. This whole course is about investing. I wouldn't trade personally, but even though investing is kind of trading on a very slow, chilled out pace. Anyway, do your own research, see how you go, and just research, constantly research. Until you're happy, don't do anything. So that's why you should always start off with small amounts when you're investing as well, so you get used to it. Okay, this is a little quick section about how to make your money work for you. As I say there, invest, but keep your costs and fees, taxes low. So things like Vanguard, like I mentioned earlier, it's a very good website they do lots of stocks in indices and things like that. They have very low fees, things like that. So if you want to get into equity, stocks and shares like that, I would recommend Vanguard. Obviously do your own research. Also, like I said before, equity, index funds, bonds, property and precious metals, or even art. Try and invest in things that give you compound interest and give high returns greater than inflation. That would be a great investment if you could do that. Don't forget to reinvest your dividends to create compounded interest. Because remember, that's the magic of the modern world. Be consistent, and one day you'll be financially free. And don't forget, like I keep said it so many times during this video, do your own research. Google is your friend. Watch lots of podcasts about it. Read books. Do courses. Look at videos on YouTube. These trains keep going past. Anyway, you should be aiming to invest at least 50% of your expendable income after you've paid your expenses. And that way you'll be able to make your money work for you, and you won't have to work for money. And here's a quick quote by Warren Buffett. If you don't find a way to make money while you sleep, you will have to work until you die. Yeah. Let's talk about what's next. We're gonna on the next video, on the next part of the course, which is probably part 5, if I remember rightly, we'll be creating a side hustle. No, we won't. We'll be talking about creating a side hustle and a passive income to help cover your expenses or to reinvest. So we'll be basically talking about some of the ways you can do it. Obviously, people have got different skills and abilities. People will be able to do different things. So let's go over what you've learned today. You have learned what is inflation and why invest. What are good investments? Yourself, metal. I've just written metal there. Properties, stocks, bonds and crypto. How long should you invest for and your targets? Remember I talked about making spreadsheets and planning out your whole life. It's pretty much what I've done. You don't have to be so extreme, but it is good to have an idea, see it on the screen or on paper in front of you when you can retire. We covered investing. Is investing trading? Yes, it is, but on a very slow time scale. And we talked about making your money work for you and what's next. Congratulations, you've now completed part 4 of 7 of the Financial Freedom course with the 7 steps. Look forward to learning about creating side hustles or online businesses and exploring passive income. And after that, we've got life purpose and what makes you happy, getting paid for what you love, and cashing out the 4% rule. Oof, God, we're almost there. Come on, stick with it. Don't forget. Thank you very much for watching and for taking part. Any comments, questions about what I've discussed today, please put them in the comments. I'm not 100% perfect, I'm not like some sort of guru. I've only been studying this for about 2 to 3 years, but I do try and give you, in a structured format, what I've learned over the years. Consider subscribing if you haven't done so already. Like the video. Please try and share with at least one family member or friend if you found value. Maybe they will as well. It'll help the channel grow. Consider following me on my other social media such as Instagram, Facebook, Twitter and Twitch. If you found value, also there's plenty of links down below to consider donating, like PayPal and Bitcoin and things like that, or Patreon, which is like a monthly thing. And I will see you in part 5. Like I said before, creating a side hustle or online business and exploring passive income. Thanks again so much for watching, and I will see you in the next one. Bye.